Hey, what's up, guys? Today I wanted to show you step by step how I personally go about setting up a hedge liquidity pool. So what it essentially is a wider range liquidity pool and a short from using a perps platform. This is ideally used when the token price is a bit high. You expect some retrace coming in the near future. You could enter into the liquidity pool because the ATR is quite high. And then you also add a short just to protect the downside. And if you have a partial short, you should still be in profit if the prices keeps drifting up towards your liquidation point for your short. And if you guys are new here, my name is Richard. I'm a yield farmer and investor. If you want to check out my portfolio, I have a portfolio update playlist on my channel. I usually go over that once a month, and I'll be making a September update in a few days here. But today we're mainly talking about hedge LPs. I'll use an example for this so that you know exactly what I'm talking about and the whole process that I go through. But basically, it's great for entering high APR pairs when the prices are high. There's less risk of loss when yield farming higher risk pairs, simply because you're balancing the long with a short hedge. And if you guys don't know, when you're yield farming in the liquidity pools, since you're pairing like different crypto assets inside the pool, you're technically long on those assets, right? When we're yield farming, we generally want to pick pairs that we believe would move up in value, but we never know what's going to happen. So it could be helpful to use a short hedge in some situations, and it's great for an overheated market. So if you guys are yield farming in like a really overheated market, you expect a big drawdown coming, then it could be helpful to have some short hedge. And you could use this exact idea on like existing pairs as well. If you guys are yield farming Ethereum to USDC, for example, and Ethereum moves up to like $7,000-$8,000, you could add a short hedge to protect the downside of your portfolio if you want to and stay in the same exact pair, right? And then the downside is you do need to monitor your liquidation level. But if you are using different charting softwares like TradingView, that's not really an issue because you can set alerts, right? As long as you're not managing too many positions, then this is completely fine. It doesn't work as well with crypto to crypto pools. If you guys are running a hedge setup, I definitely prefer a crypto to stable pool just because it's much easier to balance like the amount you need to hedge versus a crypto to crypto pool. There's lower capital efficiency since we do need to use some capital to hedge. But the good thing is you are still going to be earning like the funding rate if the funding rate stays positive on the different perps platforms. There's also less upside potential because again, you're putting a short hedge, you're shorting the token. So if the token keeps moving up in price, your upside is going to be less than without a hedge, right? But again, the reason why we could put a hedge in this scenario is to protect some of the downside. So a lot of times when you guys are yield farming or investing, to protect the downside, you have to give up some of the upside, right? Can't really have like the maximum upside while also having no downside. And this is really best for when the token prices are high in the US dollar terms. You want exposure to the token, but you expect a drawdown. And we definitely don't want to yield farm a pair just because the APR is high and you don't expect it to move up in price, right? A hedge is just there for protection. You're not believing that, okay, this token is going to go to zero or just going to keep trending down, right? You still want to believe that the token is going to trend up over time, over the next 3 to 6 months or 6 to 12 months. That's why we're yield farming this pair in the first place, but we're adding a short to protect you from a temporary drawdown. And again, I like to use crypto to stable pairs for this setup. And then if the token has a high positive funding rate, meaning that the longs are paying the short, then you're going to earn a better APR with this setup as well. So I'll show you guys step by step how to set this up. And the perfect example of using this setup is with a token like Aster. So Aster is a perps DEX platform that is backed by Binance, and it has been one of the hottest tokens recently. You can see the price action has been aggressively moving higher, right? And if you look at the daily volume, it has been quite high, more than like 100 million, right? The liquidity is sitting at 10.42 million right now. And of course, this could go up or go down. And if you guys look here, it's on the 0.25% fee tier as well. With this kind of volume, it's actually really high APR. And I'll take you guys through the process of like figuring out the APR as well. but this is a really high APR pair. But if you're not comfortable with like the maximum upside exposure, then you could be using a hedge setup in this case. So the first thing I want to do is set up like the impermanent loss calculator. This way we could see like the impermanent loss, but most importantly, we want to see like the profit and loss for this type of setup. So a ratio I like to start with is 3-to-1 for a partial hedge. So we're going to be depositing like, let's say $30,000 into the liquidity pool. You could see here $30,000. And then we're going to use $10,000 as a hedge against this token. So 3-to-1 ratio keeps like everything pretty simple and straightforward. And what we want to do is to play around with the price range. You can start with 1, for example, on the low side, and then upper is 10. And then you can see the price right now is at around like 2.11, 2.12. Moved up a little bit when I set up this chart, so I can adjust that 2.12. And then here I could see like the max upside and the max downside, right? For example, if Aster goes all the way to 10, then for this liquidity pool, I would have 52,000 something dollars, not counting the fees that I generate in the process. And if it drops back down to $1, I would end up with 16,500 something dollars, right? This is why I mentioned you don't want to be yield farming tokens that you believe would draw down heavily or move down in price, because you could lose a lot of money if the token price does not recover. But for this case, we're assuming that you want exposure to Aster. So we could be using this kind of setup. And what I want to do now is hop over to either Aster or Hyperliquid to figure out our short. So you could use whichever platforms you want. I'm going to use Hyperliquid for this example, just because you can see like the liquidation price, and it will help us run the simulation better when you can see that. So if you have $10,000 and you want to short Aster at this current price, what we want to do is take that 10,000 divided by the current token price. So let's just say it's 2.12. So this is the maximum amount of size in Aster terms that we could open, right? So let's just say like it's 4,700. So let's say you open with 4,700 with 1x leverage here. And I personally prefer lower leverage simply because I don't want to be monitoring like the price movement that much. And for like lower cap tokens, the price movement could be quite aggressive, right? So if a token moves up by like 50% overnight, then using a higher leverage could liquidate you. And if you're not using like different platforms like VFAT to automatically close out your position, then you could be at risk of like the token moving up pretty high, liquidating your short, and then moving down aggressively back to the original price. And basically you lost that money that you went short on, right? So I like to keep the leverage pretty light here. You can see the liquidation price is all the way at 3.6. So there is a lot of breathing room here for the price to move up aggressively. And I could react at any time to close out my position or rebalance the hedge setup. So liquidation price is at 3.61, right? And what I want to do now is change like the simulation price to, let's say 3.61. That's when we're going to be liquidated. And I want to know like the US dollar value of my LP. If it's a hedge setup, then I want my LP value at the liquidation price to be similar to my initial investment, right? My initial investment is $40,000 for this example. We're going to put 30K into the LP and then another 10K as a short hedge, right? So let's say the price moves up to 3.61. My short hedge gets liquidated, but my LP still have $40,000 in it, meaning that at the liquidation price, I would lose no money at all, right? And if I want to adjust the long exposure, all I have to do is adjust this maximum price here. So let's say you adjust the max price to 12. When you widen the range on the upside, what's going to happen is you're going to have more long exposure and you're going to have more capital gains when the price moves upward. So you can see just by moving the upper range just by a little bit at this 3.61 mark, I would have 40,500 something dollars, right? And we could go even more aggressive here. Let's say you want to go like pretty wide at $100 max upper range. You can see at this liquidation price, I would have a profit of 43,000 something dollars, right? So if you want more capital gains, then we can widen the range a little bit. But then again, with a wider range, your APR is going to be less. So let's just say I wanted to stick with my initial range from 1 to 10. You can see this price here. And you could also move like the lower range up. It's going to give you more capital gains because when you do that, you're going to actually be buying more Aster at this current price, right? You can see moving the lower range up would push that capital gains up by like almost 10% as well. But the downside with moving the lower range up too aggressively is that when the drawdown comes, you're going to have more capital losses, right? Let's say it drops back down to $1. You're going to be left with 14,000 something dollars on the downside here. And the downside of keeping the lower range too tight is also if the prices draw down, you're going to be forced to rebalance rather than just sitting in the position and just earning the fees, right? So let's just keep it at 1 for now, because if price draws down to, let's say, all the way to 1, you're still going to suffer some capital losses, right? Your LP value drops from 30,000 to 16,500 something dollars. But again, as long as you're staying in range, you're still going to be earning the fees in the process. So let's just say the price drops to 1. How much money are we going to make with the short? So let's just say we enter the short at 2.11, right? So 2.11 minus 1, which is the new price, right? It means that the price dropped by 1.11. And since we have a position size of 4,700 Aster, it means that for every dollar of Aster that goes down, you're going to be making $4,700, right? So we're going to multiply this by 4,700. You can see we're going to be making 5,000 something dollars, and not even counting the funding rate and stuff like that when you're being paid to keep the short open, right? So 5,200 plus $10,000, which is the margin that we provide to be able to open the short. You're going to have 15,000 something dollars in your perp stacks account, whatever platform you're using, like Hyperliquid, or if you're shorting directly on Aster, you could do that as well. And at this $1 price mark, you could add this amount, right? 15,000 plus 16,521. So then you would have $32,000 left, less than a 25% drawdown when the price actually drops by more than 50%, right? So that's pretty decent, especially with all the fees that you're earning and the APR from the funding rate. This is a pretty good risk to reward, in my opinion. And this is a really good setup if you don't expect Aster to basically drop below $1, right? And again, it depends on your analysis. I'm not saying like Aster is a good or a bad price at this price point. Again, none of these videos are meant to be financial advice. I'm just sharing what I do, and hopefully it helps you in the process. But you should be making your own decisions based on your own research. And you might be wondering, what's the APR for this particular pair, right? For the pool that I showed you guys with about like 10x volume to liquidity, is this pancake swap pool here on Binance Smart Chain at this 0.25% fee tier. And there are a bunch of ways you guys could simulate that APR. For example, you could just calculate it manually and try to like estimate the APR. Or you could use different platforms like Reverse Finance, Crystal. I'm going to use Metrics Finance for this video just to make everything simple, and it works pretty well in this scenario. So what I can see is that with a pretty wide range here, like the minimum range at 1 and then the max price at 10, I would still be generating roughly 280% APR, right? So quite a high APR here. And you can see the average volume here that Metrics Finance used to calculate the APR. So the average over the last few days is around like 100 million, which again is pretty reasonable. If you guys look at the previous few days, we're seeing more than 100 million, right? So it means that the APR estimate is pretty accurate, assuming that the liquidity stays around the same. And this is a pretty new pair and a really hot token. So I do expect the yield to drop by quite a bit when more liquidity providers hop in. And also, if this token is not hot anymore, the volume would drop as well, right? So that's something to consider. This 200 something percent APR is probably temporary. And again, I don't like to use the ranges too tight because it's really high risk. If you use a tight range, you might be able to print a lot of APR, and it could be good if the price just stays flat. But if the price moves up really high, you're going to miss out on a lot of the upside. And if the price moves down pretty aggressively, you're going to be earning no fees and suffer a ton of drawdown, right? So I like to keep mine pretty wide. And if you have the pro subscription, you could also set like the calculation method. For example, I want to have peak of distribution. It's going to see like the liquidity peak and estimate the APR. So this is like the worst case scenario APR at this current volume and liquidity, right? And maybe if I expect like the volume to dry up a little bit and the liquidity to increase by, let's say like 2x, you could expect the APR to drop to about like 50%, right? At the peak of liquidity. And of course, it's not going to stay at this peak because the price is pretty volatile and it's just going to move around, right? So then you could set this custom price as well. And then, for example, if you believe the liquidity is going to stay at an average height of kind of like this, then the APR would be like 200% roughly. If we cut that by half to be more conservative, that's still around like 90% APR on a pretty wide range, right? So if you're comfortable with that risk, then we could go ahead and yield farm this pair. And then you could simulate as well. For example, price draws down pretty hard to 1.3. The APR is going to be really, really high, right? This is also why I prefer a wider range liquidity pool. You don't have to worry about rebalancing as much. And if the price is really volatile, you're going to be printing a lot of fees. And if you want to take even less risk, you could widen the range even more, right? So for this example, we use like 1 and 10 for the lower and the maximum price. You could do like, for example, 0.1 on the lower range. And let's just say you expand the upper range to 100. And then we could see the profit and loss here. Let's say the price drops to $1. You could see that the drawdown is much less significant, right? Roughly 19,931. If you look earlier, we would have this amount on our perp stacks because of the short if the price moved down, right? So at the $1 price mark, this is the amount that we would have on the perp stacks, 15,217 plus 19,931. So you can see in this scenario, you would be down only roughly 5,000 something dollars, right? So if you go with a really wide range, the risk is much less. And it's very likely that you're going to be in range for like the 0.1 to $100 price point, right? And again, what we want to simulate is the liquidation price at 3.61. And then we can see the capital gains here. So you can see it's kind of like missing like $700. But if you're comfortable with that risk, you could still hop into this LP or adjust the upper range, right? Let's say we move it all the way to $1,000. It's then almost at $40,000 on the upside. And then if you move the upper range, if we simulate to $1, you would have a little bit more drawdown, 300 something dollars more than what we had from the 0.1 to $100 upper range, right? And we could simulate again the APR on Metrics Finance as well. Let's just use a current price for the liquidity. And then the price, right? If we do 0.1 to 100 or 1,000, you can see at the current price is earning a 138% APR. At the peak of distribution is 52% something APR, right? And again, if the APR drops by about half, at the peak distribution is like 52%. And if we move it to this pretty reasonable liquidity concentration here, then it's still a 94 something percent APR, right? Still really, really high, but much less risk if you guys go with a wider range LP. This again is why I prefer like wider range LP. It doesn't matter which pair that I'm yield farming with. I typically have like a wider range than most yield farmers simply because the risk is much lower for a wider range LP. So I hope that makes sense, guys. It's a little bit more complex if you guys are just starting out. If you're starting out, don't worry about any of this. But if you guys have been yield farming for a while, then take a look at this video, try to understand what I'm saying. It's just another tool in your tool belt that is really nice to have in case you want to run this type of setup, right? Because again, sometimes you do want to have like an exposure on a particular token or a particular pair that we want to yield farm with, but the price is simply a little bit higher than what we wanted, right? So I use this Aster for this example, but you could use it in different pairs as well. One thing that you really want to watch out for is like the amount of liquidity that is in the pair. For Aster, there is quite a lot of liquidity on the upside here. So if there's a lot of buying pressure, it's not very likely that you're going to see like a scam wick to liquidate your short, right? But for like a lower liquidity token, this is something that you want to keep in mind as well. If somebody places a really big order on like this Perstex platform, you could see a scenario where like the price wicks up really high for like only a minute or so or less. And then your short is liquidated, the price jumps back down to be really low. And then the on-chain price never really moved that much, right? So this is another risk that you guys need to consider when running this type of setup. This is why if you guys are using these type of setup, especially for a newer token, you don't want to go all in just because there are risks like that you have to actually worry about, right? And one last thing before I hop off here, one really good thing about this type of setup is, let's say the price drops down from like $2 to like, let's say 1.3 here, and you believe that's the bottom for this pair. What you could do is you could take profit on the short and then flip long by adding whatever profit and liquidity on the Purse platform back into the LP, right? So at that point, you would have no hedge and then you're positioned long in the token. And it makes sense to basically have more hedge when the prices is really high, right? And then to flip long when the price is actually really low. Because when the prices are low, we actually want to buy the asset, right? Assuming the asset is pretty solid. And this is pretty counterintuitive if you're first starting out, but this is like the opposite of what a lot of people do. A lot of yield farmers, they see that, for example, if the price move down, you're going to have more Aster inside the LP, right? So what they do to balance the long exposure is to add to their short. But then again, if the price move up, you're going to have less Aster and then you're going to lose a ton of money on your short, right? So that's just something to consider as well. But that's basically it for this video. If you guys want to learn more about yield farming and investing, be sure to check out the other videos on my channel. I try to give you guys the best information so that we could all make more money in the process. Thank you once again for watching. I'll catch you next time.